All right, good morning. It is the last Friday of 2018, Friday, December 28th, about 10 o'clock in the morning. Today we're going to cover some best and worst of 2018. Some things that we did well, some things that we didn't do well, some things that were great in the market, some things that were horrible. And with just a little bit of a look forward. But I think that today is going to be more of a review because I think it's important to understand what we did right, what we did wrong, how we can improve, and go from there. So let's start with the beginning. In January of this year, I talked to people about how there were building pressures for a massive surge in volatility. And probably about a month before we really got into the trade, I started warming people up to that. As it turned out, we had the huge correction in February. So here is where we were talking about volatility getting ready to spike. We were buying VIX calls. We talked about that. Then we talked about the option trades we wanted to do. And we were buying calls on volatility in here. Volatility spiked. I pretty much was selling my calls here. I took that money. I know that and I sold a couple down here even. I sold here, and I know a couple of people really nailed it and got it on the top day. So we were looking at rises in volatility. This is the VIX index from a number, down, 27 here, 27 here, 25 there. And the actual VIX had been down at about 10. And it had actually gotten into single digits, which was real rare. So we were buying calls, $2, $3, $4 calls. And as this went past 20 and 30 and 40, made multiples on our money. I know there's people who made like 600%. I only made about I only really doubled my money. But there's other people who were more aggressive and wrote it up. So that was one of the best things. We took profits. Then in here, we were basically buyers of the stock market. And quite a few of our stocks did all right. We missed some trades in here, which is a chart that I showed more recently. So we got the volatility trade right. We're buying stocks here. We talked about money flow a little bit back then. Money flow troughed out. You become a scaling in buyer over a month or two. Then money flow goes back up. Stock market goes up. Clearly what you can see this year is that the traders had a great time. Buy, sell, buy, sell, buy, sell. Thought it was time to buy. Wow. The ferocity of this move in the fourth quarter is ultimately where we got to at the end of the year. And it was a violent move down. So, technical traders who were calling this part of the collapse got it right. Here's the problem, is a lot of those technical traders are just wannabes, and they called many other parts of this wrong for the better part of a decade. So you really have to consider who you're talking to, who you're listening to when it comes to technical analysis, because a lot of those analysts aren't very good at what they do. They really are just, they're a type of trend follower that doesn't really understand what underlies the trend. And remember, we were selling in here, but we bought too early because we started buying in here. And December kicked our butts. So what do we do about it? Well, I think one of the things we have to consider is how fast this market was moving. These are all very unusual changes in money flow. You normally don't see money flow go up and down this many times in a year. So what does that indicate is coming? I don't know that it indicates anything. We are at the support levels that, once again, I talked about a long time ago, back during that February correction. I was actually looking for these charts, but Office is not showing me the previews. How low can we go? I showed this chart way back in February, January, February. I said this is incredibly strong support in this 220, 230 region, right in here, right? We got down to what, 237 the other day, and we're at about the same today. Let's see, the SPY is 247 today, but it was 237 the other day. And that was just another one of those technical levels that a technical trader will tell you is a big deal. So do we enter a bear market? We're less than 1% away from the bottom to a bear market. And do we go down to this support level into the 220s on the SPY? I don't know. And I don't think that it matters. And the reason I don't think that it matters is because so many stocks are looking pretty good to buy right now. So if we take a look at our VSL, people asked me, and this is all getting revamped for New Year's, so I don't mind giving you out this URL if you're not a subscriber. But I had these bottom fishing prices. And earlier in the year, nothing was close to their bottom fishing price. And people are asking me, well, what should I buy then? And a lot of times my answer was nothing. Stuck with a handful of technology stocks, a couple of our favorites, Nutrien, I think is just poised to go much higher in the next 4 or 5 years. Accidental, these are dividend stocks. But now we see a lot of stocks close to those bottom fishing prices. But some of the stocks are still way higher than I think that they have to be. I think technically and quantitatively and factor-based, whatever thing you want to use, there's a lot of reasons a lot of these stocks could still go much lower. But some of our favorites, a lot of them growth stocks, got crushed. So I've got NVIDIA under growth and dividend stocks. I think they're going to increase their dividend ongoing and keep buying back shares, but they have to get through 2018 cyclical trough that might last into 2019. We don't know. But it is priced pretty well. It's close to huge support levels. go down, and you see lots of stocks like that. Kind of way underneath where it belongs. Floor, way underneath where it belongs. And when does floor win? Floor wins if there's ever a infrastructure bill. Elmer Campaign, biggest land driller. I know people like to look at Schlumberger, but they have such a huge deep sea presence, deep water presence, and I don't think that's ever coming back. How does Schlumberger do long term? They have an entire division, a big division, that is ultimately almost worthless, and it's not written on the books that way, but eventually it will have to be, because deep water drilling is going away. Some of the property groups are beat up because of the rise in interest rates. Store Capital held up though. This was one of the ones that we bought in the middle 20s. WestRock, interesting company. CenturyLink just got crushed, had a nationwide outage. It was all the way back to their bottom fishing price. AT&T is all the way to the bottom fishing price. Remember, we started buying AT&T at about 32, knowing that, hey, yeah, I could get into the upper 20s. Well, it's in the upper 20s. AT&T is probably a screaming buy right now with a dividend of, I don't know, you tell me, it's about 7%. Yeah, 7% dividend on AT&T. How can you not like that? Oh, but it might go down more. Really? That's the response? It might go down more? How much more can it go down? Right? A couple more dollars maybe? To Great Recession lows? Do we really deserve to see Great Recession lows on anything right now? I think that's a pretty serious question. Do we deserve to see Great Recession lows? Pick a stock. Who's got a stock they want to look at? What stock has gotten the crap beat out of it? Fell off a cliff. Very close to, I actually was a seller in here. Well, I didn't think it was going to break out here, and it did. So you got that breakout. Now it's all the way back just above this area. What about Apple? Is Apple a buy or a sell? But it could go down more. Yep, it could. It could. But at some point, the stock market starts to discount any positive catalysts and fully prices in any negative catalysts. So I think the question that we have to ask right now is, with such a huge correction at the cusp of a bear market, and bear markets usually last about 2 or 3 quarters, if we really enter a bear market here, one, do the catalysts for positive surprises become more likely, or do the catalysts that are negative surprises become more likely? Well, if the negative catalysts are pretty much fully priced in, then it doesn't matter if they happen, right? They're already priced in. So now you have to start taking a look at the positive catalysts, which are not priced in. What if those do happen? So I hope you follow along there. The market is pricing in a lot of bad things. So it doesn't really even matter if they actually happen anymore. They're priced in already. So if the bad things do happen, if we get the big economic growth slowdown, right? If the trade war gets worse, if the Federal Reserve remains very hawkish, and by very hawkish, that's relative, because they're not hugely hawkish compared to historical terms. I just think they're hawkish compared to the demographic, slow growth, forever reality that we're in for the next couple of decades. If that Fed backs off, becomes a little bit more dovish in coming weeks and months, And if there is a deal with China that's a marginal improvement over what we used to have, then those are negatives that don't happen, but are already priced in. So I think that it makes a lot of sense to be a buyer here. I talked about that in basically articles for the last 2 weeks. You know, December 12th, kind of right size the QQQ position to raise cash. And then within 2 weeks, and this didn't happen. I mean, we're in this area, but it looks like by the end of December, we should probably be buyers. So folks who had raised a little cash the second week of December, by the third and fourth week of December, with as fast as that drop was, probably should have been looking at doing some buying last week. And especially if you weren't doing last minute Christmas shopping on Christmas Eve. Christmas Eve morning, you probably could have been doing some shopping. And what do we want to buy? As I've said over and over again, we want to scale into what's higher quality. I think that this is very important that you own some of this. My core 5 stocks are those 5 right there. And Apple I hadn't owned for a while, but I own it now. Apple, Google, Amazon, First Solar, and PayPal. And I want to show you a chart that I had up at one point. Oh, I accidentally took it down. But take a look at QQQ here, last 1 year, fell off a cliff. More importantly, from here, that plateau area, which lasted about a year, and then after the Fed, and this is about where the Fed paused last time, and oil prices came down. So a pausing Fed and low oil prices, and that's the rally we got. This was a hawkish Fed, but falling oil prices. Now oil prices are probably going to drift up here, probably about 50% by summer, but the Fed's going to pause. And now we also have this trade deal. So I think everybody is starting to assume the oil prices are going to drift upwards. At least that's what some of the best managers are saying. You still have some trend followers who are saying that it's going to keep going down, but does anybody really believe? I mean, seriously, does anybody believe that Saudi Arabia and Russia are going to take nothing for their oil? Something's going to go down. They're already reducing exports to the United States, and they're already cutting production. And this is in light of the Permian, which is most growth of U.S. oil. U.S. oil is almost all Permian growth. Gulf of Mexico actually has leveled off already. This is a year-old chart. So this number is way down here now. This number is further out. We know that the Permian growth in the first half of 2019 is going to be almost non-existent. How do we know that? They don't have the pipes to send it anywhere. So they're going to start ramping up their production starting around summertime as some of these new pipelines come on. So when you take a look at it here, again, think of catalysts. Think of what can drive the market up or down. If we have a financial crisis, certainly we can keep dropping down. What are the odds of a financial crisis? Pretty low. I think we're already starting to see the jitterbug here. And if we get in the first quarter a trade deal, and that first Fed meeting in January says, hey, we're not raising here and we think it's going to be a while till we raise again, the market could make a run at a double top. And it makes sense for there to be a challenge with a double top. Some of the very best technical analysts I know say they're going to challenge the double top. Get back up here at some point. Don't know exactly when, sometime in 2019. At that point, we have to figure out, is the economy getting better or worse? Truly, is it getting better or worse? Because if the economy is getting better by the second half of 2019, if there's more growth, if the growth slowdown does not occur, right, which is already priced in, then you could see new highs again. Here's my guess. My guess is that we challenge these highs, do the double top. At that point, you want to get rid of all of your leverage, except maybe a little bit that's been rolled out, and to give you a little bit of extra exposure if there is a breakout. If I had to call this right now, I'd say we're going to jitterbug around here for a few weeks, and we're going to build. We're going to rally up towards the high, might even set a new high, false breakout sort of thing. And then I don't think the economy actually is picking up. But I don't think it's going to be horrible either. I think that we're in a range now for a while until we have more certainty about what's happening with the economy. What happens with the economy will be dictated by two things. It'll be the Fed and it'll be global trade. As traders, we have to be aware of the money flow into and out of the market. So right now, it looks like money flow out of the market bottomed again in the last week, and it's starting to move its way back up. But again, these moves have been pretty quick, and they haven't been super heavy. It's been a thin market, and these numbers have moved around a lot quickly. So if you're a longer-term investor, I think the only thing you can do is buy value, and you go with high quality. Those 5 stocks I showed you, I think, are probably good, really good core holdings. I know some of you are going to say, well, why First Solar? I pulled the chart up. Here's why First Solar, and this is an older chart, but it's recent enough. What's growing fastest? Solar is the fastest growing energy source by quite a bit. So First Solar is the leader in utility buildouts, and the utilities have a huge advantage over everybody else. Why? Because the government's kind of on their side. They already have relationships with the government to build out. And the idea that we're not going to see more and more climate change policy or climate change related policy in the future, if you want to believe that, go ahead and believe that. But I'm telling you that you're wrong. Maybe President Trump doesn't cut any deals on climate change policy, but somebody will, and by somebody I mean hundreds of, dozens of other major economies. But there really is. There's 200 signatories to the Paris Accord, and in fits and bursts, they're moving in that direction. China is already seeing diesel demand flatten out because they're moving towards more and more electric buses and sprinter vehicles. So, you have to consider the reality of what's coming, whether you believe in climate change or there should be climate change related energy policy or not. It's going to happen anyway. So of those 5 stocks, Apple is a cash machine, and they have 15% of the handset market in the planet, and that will continue to drift up. Not a lot, a few percent a year. It's not going to be the 20, 30% growth rates of the past. It'll be single-digit growth rates. But they're moving towards renewable income that's, subscription-based. So it's renewing income periodically. And that's going to be everything in the smart everything world. Smart cars, smart homes, all sorts of things to do with entertainment. So Apple, interestingly, their 15% of the market is among the most affluent people in the market. People who will subscribe to something for $20 or $30 or $99 to make their life easier. Apple's going to get another big growth phase in the next few years. Are they going to chop around here short term? Maybe, but they're churning out so much cash that it's probably not going to be too terribly bad, and we may have already seen the worst of it. Google. We've talked about Google before. They are going to be able to spin off 6 or 7 or 8 or 9 or 10 companies in the next decade. And I think because of the regulatory overlay that looks like is coming, they are going to spin off a lot of companies. And it's pretty amazing that most of these companies will start as 20, 30, 40, $50 billion companies. They're not going to be $2 billion companies. They're going to start out big, probably at the edge of the S&P 500 and then moving into the S&P 500 relatively quickly. So you want to own Google. It's cheap right now. They're sitting on $100 billion of cash. And remember, Google's godfather is the CIA. Google's source funding came from a CIA private equity firm. That's real. That's true. You can Google that. Amazon, I think, splits into 2 companies, but even if it doesn't, the amazing profitability of the web services side probably just keeps growing because of the cloud-based storage that's out there, and because of edge computing coming. They're going to be the linchpin, one of the linchpins in there. First Solar we just talked about, and then PayPal, again, looks like it's integrating itself with the global payment system, and that's a big deal. So when you think of PayPal, I think you should think of Visa. Take a 10-year look at Visa. I think this is what PayPal could look like. So Visa, by the way, if you're looking for blue chip stocks, probably a decent one to throw in there on this pullback. Again, it could come down further. I'm not saying that we're definitely done with this correction. There could be another 10, 15% downside. But I just think that we're close enough on valuations on certain stocks that when you take a look at some of what we have been watching, some of them have gotten there, right? Growth stocks in particular. A lot of growth stocks that are pretty beat up. So let's talk about one of the worst things in 2018. Talk about Micron. And with that, I'm going to introduce you to Dave Zanoni. All right.
Hello.
Hey, Dave, can you hear me? I can hear
yes.
you.
Can you hear me well?
Can everybody else hear Dave?
Yeah.
Somebody
Hello.
say yes. Yes. Yeah. All right.
All right. Okay.
So welcome our new analyst, one of 5 that I'm looking for in the next year.
Mm-hmm. And I'm looking forward to working with you guys.
Great. So, hey, Dave, why don't you tell us just a little bit about yourself, where some of your experience comes from, and how you started doing this, and why you're doing it?
Okay. Yes. So basically, I'm basically self-taught. I grew up in a kind of a middle-class family, and basically still middle class, just trying to get, do the best I can to retire. About the same age as Kurt, 47, and basically what I look at is I'm kind of focused on momentum and growth. When I say momentum, I'm not just blindly following, the charts, things like that. I try to look at the future of the company, look at the fundamentals, look for companies that are going to grow above average paces over multiple years. So it's basically kind of in line with Kirk's philosophies. And basically, I mean, most of my money is in 401ks, but I'm also, trading outside of that. So I don't have a whole lot. I'm not like a, industry insider and things like that, but I'm just kind of like a regular guy, down to earth. And I don't work in the industry, the investment industry. So I'm
Dave's not really a down to earth guy.
right.
You should see the way he dresses. He looks like a rock star.
Yeah. That's funny you mentioned that, because I did used to play in a cover band back in the day, but but now I'm more focused on stocks. So.
Well, we can see in this picture here that, you look pretty happy there, but they don't see the leather pants, right? They don't see the leather pants, and you were nice enough to take off the scarf there and put it on the side, but
that's right.
So, one of the companies that Dave and I have both covered over the last several years has been Micron, and we're lucky enough at with my investment letters to have a couple of pretty semiconductor industry involved people, so we get some good information. And one of the things that I've thought about Micron is that while the traders were very popular or very powerful this year, and we talked about that in the one of the most recent articles. Is this your article?
Yes. Mm-hmm.
All right, we're gonna have to figure out. Is it still listed under you too? Okay, so they listed in both places now.
Right.
Interesting. I didn't know that's how they did that. All right, well, they got that up there though. That's cool. So, 4 pieces of missing money article. I think this is important to understand this in the context of a lot of the individual stock movements, and we'll get back to Micron in a second because it applies to Micron. As we've talked about in other calls, and you should read this article, right? 4 pieces of missing money crushing markets. There are different pieces of money missing markets that aren't in the markets anymore that were before. All the demographically missing money is not coming back for a long time. Eventually, the millennials will offset it, but they're a decade away. The Fed's QT is a big deal. That's the one that could be most variable. There's low Chinese investment back into the United States economy and low FDI in particular at the moment. And that is really contributed to a thin market, right? The buy the dip buyer was gone in the last quarter. And it was especially exacerbated by the hedge fund liquidations. So of those 4 pieces of money, what's coming back to the market? Well, the hedge fund money will come back in the first quarter because the money that was liquidated back to investors, those investors will look for places to invest that money again. Will the Chinese come back? I don't know if they come back as much as they were, but I think they come back to some extent in the first half of 2019 because I do believe that there will be a trade deal. And I think that the Fed, at a minimum, pauses on interest rate increases. And if there is any softness in the economy, if there's any actual softness in the economy, they will stop shrinking their balance sheet. Maybe not all the way back down to 0 buybacks per month, but they're at 50 billion in buybacks per month off of their balance sheet. Well, that's $600 billion a year, which is about 3% of GDP. So the idea that we can put a negative 3% number on GDP in 2019 is pretty astounding to me. That means that they really expect the economy to be super strong if they have to try to tamp it down by 3%. And think about that. If GDP growth is 3% and they take 3% out, that means 0 GDP growth on net. So they must be expecting 4 or 5% GDP growth. right? That'd be the only logical explanation. Maybe there's no logic there. But this $50 billion number they're taking off the Fed balance sheet every month, that cannot stay on autopilot if there is any slowdown in the actual economy. So, all right. Apparently, the ads that show up on my screen, they give you some insight into what I was looking at for Christmas for my girlfriend. But let's go back to Micron. So the market was thin. The buy the dip buyer has been gone most of the quarter until the last couple of days, and that's really, as we know now, pension rebalancing. So we know that about $60 billion of pension funds money had to be rebalanced back into equities, and that's what we saw the day after Christmas and in yesterday's snapback. And today the market's about even, so we'll see if they're still buying into the close. One thing that I do want to remind people of is traders trade at the start of the day because they're trying to catch a quick move or a trend into the middle of the day that they often will fade. The smart money, I'd say the big institutional money and the real good money managers are looking to see what's happening in the last hour of the day as it portends to overnight and back into the next morning. So when the end of the day is up, you're generally getting smart money buying. And when the end of the day is down, you're usually getting smart money. And by smart money, it doesn't necessarily mean that it's smart. It's the big money. It's the institutions. You can see what they're doing. And a lot of institutions, for example, mutual funds, still control a ton of money. They are buying and selling at the end of the day because they have to balance their portfolios. So on a daily basis. So keep in mind that if you're seeing big buying at the end of the day, that is to some level institutional buying, very large level institutional buying. And, you have your high frequency traders skewing things to front run that might push things up a fraction of a percent or down a fraction of a percent on top of whatever the regular move is. So again, bring that back to Micron. Micron is a company that is smack dab in the middle of a huge secular uptrend. So when we take a look at the Core 4, which is getting a brand new name for the start of the year because I have to trademark something and somebody else had Core 4 trademarked. We want to take a look at big secular trends. And the smart everything world is clearly the biggest secular trend, with climate change policy probably second. Demographics, I suppose demographics are first. But it's hard to bet on improving demographics, and we know it's not going to improve. That's why we only have foreign investments in a handful of countries where the demographics are improving. India, for example, Vietnam, maybe a couple of South American countries. But with Micron, the smart everything world is good for them because DRAM is something that they are part of an oligopoly with Samsung and HK. So these guys control a lot of a market that is going to keep growing and growing and growing. And the traders, and I'm going to tell you again, don't listen to a trader's fundamental analysis because all they're doing is fitting the fundamental analysis into the trade that they're making, which is actually based on technical analysis. So when a trader tells you this is my fundamental view, therefore you should do something, ask them what their technical analysis says, because they might be a lot closer to a pivot point than they're letting you on to. They're usually just fitting the fundamental story into their trade. So traders are almost all technical traders, and they're using charts. So the fundamentals don't matter much to them. We here are going to be using more and more quantitative analysis, quantitative trends. Maybe you can smush some of those words together and get a word out of it. It'll be trademarked soon. But the money flows into and out of markets and into and out of individual stocks, which are often influenced by the money into and out of the market, usually is, really beat the hell out of Micron. And the idea that Micron is still a highly cyclical company is wrong. You can take a look at the pricing of semiconductors on the spot market. You can take a look at the seasonal demand shifts. You can take a look at the way that inventory is moving right now. There is some cyclicality in semiconductors, and probably always will be, but it's to the point now where it's similar to the rest of the economy. You have seasonality as well. More semiconductors sold at certain points of the year. And then you had a weak market. So you have this narrative of holy cyclicality in semiconductors because they used to be highly cyclical when the market was more fragmented and they would get flooded with product. But now the product is more complex. It's difficult to produce, and there's fewer producers, not only in the DRAM space, but in NAND. So NAND is down to about a dozen producers on the planet. DRAM is really 3. And this is way down from the past when I believe it was 9. Dave, how many producers of DRAM were there about 7 or 8 years ago? Was it 9? I think it was 9, right?
Yeah, I
9
think
or
that's
10?
about right. Mm-hmm.
Yeah, 9 or 10, down to 3. There was some consolidation, some M&A activity, and some bankruptcies. And then NAND, I want to say NAND was up at around 30 producers about a decade ago. And, Great Recession wiped a lot of players out, down to about a dozen. So the technical analysis here of Micron, I always add the money flow, is that you had this huge fall off in money flow. Stock gets crushed, right? 40-50% drop. And if you take a look at this on a weekly basis, 20-week period, so when it says 20 here, that's how many periods. So if you're measuring by day, that's 20 days. Measuring by week, that's 20 weeks. You can see that over the longer period, money flow went down all year. Stock price doubled to peak, then down ever since summer. So from 60-ish to 30-ish. I've basically called the bottom here right around 30-ish. And I'll tell you, I thought it could have held this, but the market got way weaker than even I thought it would get. So now we're down to this level. Money flow seems to have kind of double troughed here. Looks to be turning up. In the first quarter of the year, we're going to get the retirement plan money back into the market first. And then the hedge fund money will come back. And then maybe the Fed will give us good news. And then maybe there will be a deal with China. So all of those positives are not priced into the market. But all of the negatives are mostly priced into the market. So which side of those bets do you want to take, right? I think that Micron, you should be nibbling in right now and rebuilding your positions because I think that Micron is probably one of the best growth stories out there. One of the things that we're going to do here at Fundamental Trends and at Margin of Safety Investing and in the new service that I'm launching along with presuming everything goes through, I'm going to meet them down in Florida, it looks like. I'm going to be launching a new, I'm not going to tell you who it's with. Some of you I've already mumbled it out before, but there's going to be a third service and it's going to be based on sustainability types of investing. But all these services are going to have a SWOT report on our core stocks. So Dave wrote this one up, And it needs, we need some copy editing here and put in some pretty bullet points before we post it. But in the future, every company that we cover, and it's going to take time to get them out there. That's why I'm hiring more analysts like Dave, and I'm talking to a Motley Fool guy who I've known pretty long. We're going to do SWOT analysis. So you can get the lay of the land. What's the basics of this company? What do they do? What are their strengths? What are their weaknesses? So strengths are internal. What are internal weaknesses? Opportunities, what can they do external? What are the external opportunities? What are the external threats? So we're going to go through this. One of the external threats obviously is China. What could that do to Micron? So Dave, what do you think about Micron? What do you think is the one or two or three things that are most likely to impact Micron over the next 1 to 2 years?
Yeah, so I think right now it's getting killed from the basically the supply issue. When you have an oversupply of DRAM and NAND in the market, it's going to cause basically Micron stock's going to get crushed, and that's what we've seen previously in years past and what we're seeing right now. So I think the long term really looks good on the demand side. You've got the smartphones, mobile devices right now in the market driving demand, and then in the future you've got stuff like Internet of Things, artificial intelligence, autonomous vehicles. That's a few years away, but that's just going to grow. So I think what you have to get into a better supply situation where better supply demand balance. And what I've noticed, there is the stock price of Micron actually tends to lead DRAM prices at the bottom of the cycle by about 2 to 3 months. So they're saying, I know the estimate is maybe second half of 2019 is where the supply situation could recover. So if you're looking before that, you could look in the first half is where the stock could recover. So just a possibility. I don't know exactly when the bottom's going to take place, but I think right now, if you look at what happened to the stock already, the upside is a lot larger than the downside at this point.
Right, and I agree with that. So I had thought there was a pretty good chance that Micron holds, those 40, 45 price levels, and I was starting to buy in there. And now we're down around 30, which is another 30% down. And again, I think it comes back to what is the market pricing in? And again, because the market was thin, because there was a lot more selling from big investors, and because the Fed was sucking more money out of the economy than they had in the previous quarter, because that jumped from 40 billion a month to 50 billion a month in October. You had the hedge fund liquidations. I think that we ran into a perfect storm, China not being in there. Those four big pieces of money that weren't in the market in the fourth quarter, I think that was a perfect storm to really knock out a correction much, much faster than anybody anticipated. And, I talked about all these things throughout the year, and then I did not trade it all that well. So I don't like that I didn't trade it real well. We went into the fourth quarter holding cash, but we started buying 6, 7, 8 weeks too early. And, it's because I think most people didn't understand that all that money was missing and what the impact would be. So that huge turnover in the fourth quarter. Oh, where did my chart go? Yeah, huge tail off in the fourth quarter. I mean, this is, if it wasn't so bad, you'd say it was spectacular. I mean, just look at that. From 280-ish on the SPY to 230-ish, 234. I mean, holy cats, in 1 month. That's scary, right? All right. So when you're scared, when it's the hardest thing in the world to do, Is it usually the right thing to do in the stock market? Usually. Usually when things are beat to hell, when it scares you the most, you should be a buyer. Especially down here, you can see that the money flow out of the market has bottomed. It's close to the bottom. And we know for a fact, this is fact, we know that in the first quarter of the year, tons of retirement plan money comes into the market. All the employers make their contributions on behalf of their employees, and the bonuses, the year-end bonuses that largely go into 401k plans. The hedge funds have all pretty much been liquidated. The checks are in the mail. Those folks are going to look to reinvest come Q1, Q2. And again, I think the odds of a Fed pause are pretty strong. Maybe a pullback in QT, although I don't think that happens unless they see real weakness. And again, I still think that there's going to be a deal with China, unless China just decides, they really want nothing to do with Trump and they're going to wait him out. So we'll have to see. There's uncertainty on when the rebound occurs, but I think that most of the downside is in. Again, could there be another 10 or 15%? There could be, but if you're taking a look at individual companies, which is what you should be doing at this point, don't try to guess the direction of the market. Just try to understand it as best you can, what it's doing and why, and then try to find your companies. And Micron is on our list. I thought I was going to hold $40. It didn't. It's down close to 30. This is way below our bottom fishing prices, and my bottom fishing prices are pretty aggressive. What would you have thought when Amazon was 2,000 and I said that it probably goes to around 1,600 and that's where we have to start buying it? I'll tell you what some of you thought I was nuts. When I said the Alphabet could get as low as 830 and it was 1,300 or whatever it was, said I was nuts. Well, it got under 1,000 briefly. And this number has also been 950. I vacillated between 950 and 830. So there's a range between 950 and 830 where you ought to be piling into Google Bet. And some of these other companies too. Some of these stocks have just come down so much. Berkshire Hathaway probably can never get to 127. I haven't updated that. I think I recalculated it at 154. I'll double check. There's a price at which Berkshire buys back their own shares, and that 127 reflected what it was probably over a year ago. So I think their discounts to I think it's book value they're using. I have to look up what the formula they're using again. I think it comes in around 150 something. So I'll update that. I'm just going to leave it blank for now. But Berkshire, remember, they buy back their own shares at a certain price, big time. But that's what Apple's doing as well. So, you take a look at Apple. They're in the down now. I said they get down as low as 130. Again, people thought I was out of my mind when they're approaching 200. But now here, you see them 157. I think they're 154 the other day. Yeah, they're getting darn close to some of those hard bottom areas. And I think you have to buy some of these stocks. DuPont. If you're really a long-term investor and you just want dividends and something that beats the economy by a point, I think DuPont's probably a good company for you. Remember, they have some strategic moves coming. Goldman Sachs. If we're not going to have a financial crisis, Goldman Sachs, evil bastards that they are, is looking pretty attractive. IBM, they've just gotten slaughtered. And at this point, everything bad about IBM is priced in. Remember, Buffett sold at what, 150, 160? And now it's down to 113. There might be value here again. And this doesn't, bottom fishing price doesn't mean jump in, blindly. It means, okay, this has gotten so cheap that you better start reading up because you might want to buy it. United Technologies, they're doing some strategic transactions. I think United Technologies is pretty interesting. I still have a sell rating on United Health Group, and probably go to 1,000, and I'll still have a sell rating on it. But such is life. I think there's a huge bear market coming, especially for the pharmaceuticals in healthcare. I think there's a huge bear market coming, and I hope it doesn't spread to everything else. Again, Crash 2020 is based on all the bad things actually happening. I still think United Healthcare is in deep doo-doo. Anyway, back to Micron. Here's my free stock pick to the end of the year. I think you should start slowly accumulating Micron, maybe buy a little stock, sell a $27, $28 put for a month or two out. Try to get a bid price. Try to get the ask price when you sell. Try to get the bid price when you buy. A lot of things that DRAM's going into, right? Forbes covered this. A lot of positive catalysts over the next couple of years. The market for DRAM is constantly increasing. That probably lasts for a decade or more. That's kind of long-term growth you want. Their margins will probably stabilize here, which is not far off from the 59% record they set. But I'd say margins in the 50 to 53% range, which is what they're saying. I do think that this was a kitchen sink sort of quarter for Micron. And I think they're likely to beat most of their estimates unless there's a bad trade result. And then they'll come in at the low end or maybe even miss. But again, with as much money as they're making and the buyback they're doing, they have found some pretty darn good support. Some of the technical traders will say low 20s, maybe, in which case I'd start to buy leaps. Dave, you got anything else on Micron? I mean, I think we're going to finish up on them. But,
right. I think you
what
don't
else
have
do
to
you love?
Yeah. I like, your core stocks are great. I also like, I think Facebook got beat up a little bit too much. There's some headwinds there. I mean, I don't think you have to jump in right away, but I would like to look at, even with Micron, some of these stocks, try to look for the uptrend before jumping in. Unless I think that strategy that you mentioned is great too. Put sells, for those that can scale in. That's a great way to, you can earn some income before you get your buy price, where you could get multiple buys in that as well. As things are going down, if they do go back down. It's hard to say when the market's going to bottom out, but I think it's looking at a lot of growth stocks. I do like Apple. I agree with your core four like Amazon, Google are great as well. But I also recently wrote about Darden restaurants because that's something people do on a regular basis. People don't stop eating basically, and going out is something. They have multiple tiers of. They have an upper echelon. They have Capital Grill, which is a more higher end, and then they offer the Longhorn and Olive Garden kind of caters to the more middle class. Right. Common people, people, whatever's happening in the economy, people are pretty much
bottomless salad. Mm-hmm. That's where I'm going to be
right.
in 2019. I had to stick with salad in 2019, and I got to get her away from that chicken fried steak and fried steak and it's Cracker Barrel. I have to shift my Darden habits. So
and then they've got a lot of store growth as well, so I think they'll do well as the market recovers.
How do they do with the millennials?
I think pretty good. They've got it's a price point is good for them with the the Olive Garden, Longhorn, things like that, and then the Capital Grill, that's more for the higher end markets. But I think the millennials seem to do well with Darden. On the lower tier, I think the Olive Garden and Longhorn, and then there's Bahama Breeze. That's kind of more of a trendier type place, where more for drinks, and they get a lot of their income from the drinks, the alcoholic drinks. Basically, they have good margins on there, and that's where they make a lot of their money. So I think it'll be a good long-term play. If you're looking at the next 3 to 5 years.
Right, and I think that again, we'll take we'll take a look at that in a second. We'll keep going here for a couple more minutes. We'll make this end of the year one a little longer. We're almost at an hour right now, but let's just take a look at the semiconductors: Micron, NVIDIA, and then XSD. This is the semiconductor fund I use because some of the solar stocks are in there. You can use some of the other one, the Philly one, but this is the one that I use. And you can see that the fund is outperformed on the downside because certain stocks get the crap beat out of them. So the question I think you need to ask is, okay, so Micron and NVIDIA have trailed in the last year. We've covered the reasons why in previous weeks. Had a lot to do with the drying up of the cryptocurrency mining because Micron was getting marginal pricing from that. Even though they didn't sell a lot into it, they were getting marginal pricing. Then NVIDIA actually, they rolled that up and they rolled that down. Here we go, up, way up, and then way down. So they ended up all kind of going in the same direction. So over 1 year, NVIDIA and Micron have trailed the index. Over 5 years, there you have it. That index beat Micron, but NVIDIA crushed it. If you had gotten in on NVIDIA and Micron back in here and traded it well, right? And that's it. Unfortunately, there is some merit to trading things. And I just want to show you the NVIDIA chart. Why cash flow, again, is so important. Again, when you go to the longer periods, it becomes much more apparent what's going on, right? These short periods are a little bit hard to figure out. You go to the longer period and you look over longer periods of time, it really starts to make some sense. So we want to go to 13 weeks, which is a quarter. Look at that. From positive 30 to negative 30. And 0 is the oscillation line, right? So that's a 60% swing. A lot of money getting sucked out of NVIDIA. When this happens, take a look at it over a much longer term chart. What happens to the stock price when it troughs? So for a year, you got that rise. Kind of broke apart here for a while. You get the jitterbug. Shoots back up. You get the rise. Starts to fall off. You get your peak. And then it falls off. I think money flow into a lot of these stocks is going to come back in the first quarter. So you should have a scaling in strategy for your favorite 10 to 20 stocks. You really don't want to go beyond 20 stocks, in my opinion. 30 if you have legacy positions. But, if you're trying to manage more than a 30 stock portfolio, you are a better person than me. Yeah, probably most of you better persons than me anyway. So, all right. So Darden, what's the symbol for Darden?
That's a DRI.
Okay. So take a look at Darden on the weekly scale. Again, crushed. Stock came down. Now, could it come down further? I think there's an argument that on technical, and we'd have to really analyze this. I think there's an argument technically why it could come down further, but look at how far down this is come. Could this chop around down here for a little while? It usually doesn't. Usually the institutions, find a pivot point and they go with it. So you're probably gonna see money flow starting to work its way back into here. And could you get another leg up? Again, I think a lot of stocks are going to challenge their 52-week highs and even their 2-year highs. I don't know how many of you use bar charts, but bar chart's a pretty interesting tool. I bought it just for this and for the options screening. So you don't have to buy something from Peter Najarian and John Najarian because this is way cheaper. This is $29 a month, and in fact, I just asked them if I could get you all a discount on this too. So I'm gonna try to have some discounts for you guys next year in the first quarter. The software that I'm using for charting, I'm gonna have a discount for, and it started out cheap. And then bar chart's interesting. I think this is worth $30 a month. Look for ideas, but what we know is that stocks that lead generally keep leading. Here's the one that made me. This one stock right here made me a millionaire. One stock. So we don't need to find a lot of these. I'll tell you, the people who traded cannabis from the bottom, they made a lot of money. I think that most of these stocks crash by 70 or 80 or 90%. But if you're selling into the strength right now, if you bought this at 30 cents or you bought this at $1, you should take out probably 90% of your money that's in there and call it a win. Because the big growth, at some point the big growth here is going to be gone. You take a look at the 10-year numbers even. How do you know which ones? See, this is, I should buy a present for the CEO, Kevin Conroy, but he's already rich and he's probably going to be governor, so I'm not going to bother. But, this is the one that did it for me. Peter Lynch talks about that. You don't need a lot of huge winners because it carries the rest of the portfolio. Rest of the portfolio, try not to get blown up. We have had a hard time in the last month because we had some leverage on things that got crushed. So we have to make that money back. And probably the way to do it is find companies that, and I'm looking for companies that'll double or triple over the next 5 years with the potential to do better. Who are going to be those companies that go up 500%, 300%, 200%? They're in the last 5 years, there's, 50? I think this is a list of 50. 10, 20, 30, 40, 50, 60, 70. Yeah, this might be 100. So there's lots of companies that we should be able to really do well on. And when you compare the 1-year chart and the 3-year charts to the 5 and 10-year charts, you find a lot of overlap. So we can really go to this 3-year chart. And this is something that I'm doing. This is something I'm going to be using to add to our growth list is, okay, of these companies that have been killing it, especially some of the ones down here, which ones are likely to keep doing well? And you just work your way up. And I've downloaded this into Y charts so I can see what industry everybody's in. Say, okay, what is Cardex? Cardex, why are they making money? CDNA. What is, Fresh Pet? That just scares me, but I'll look at it anyway. So you start looking at these companies and you break them down. We know what World Wrestling Entertainment is. They're probably done growing because their age group is changing. But you take a look at these, okay? So why is this company, Oncology Cancer, why are they making money? Are they profitable? If they're at that cusp of becoming profitable, that explains the rise. And then you have to say, okay, is the positives priced in or is it the negatives priced in? We're going to be able to find companies on this list in the next weeks where the negatives are priced in and the positives are not priced in. And if we can give ourselves multiple opportunities to catch some of this pricing as it rebounds, then we probably have a pretty good chance to beat the heck out of the markets. So, 3-year high. These guys, the one at the top of the list is 30% off their 3-year high. These guys, it looks like about 30% off their 3-year high. I bet there's a lot of stocks 30-ish% off their 3-year high, 40%. I'll look at Kirkland just because my name's in there. This one, look at that. That one's down in half. Cannabis is already getting crushed, right? So if folks were selling near the highs, look, already down over half. And I'm telling you, it's going to end up being 90%. This is going to end up being a $5 stock. This is going to end up being a $1 stock. Why? Because you heard it here first. There's actually a surplus of marijuana already. Did you know that? There's actually already a surplus of marijuana. And I don't think you're going to turn a lot of people my age from not doing it to doing it. I mean, not that I haven't done it, but I didn't inhale. I'm just, I might be lying. But in any case, I did know a woman who gave me a caramel one time, and it was a very good caramel. And about 10, 20 minutes later, I'm like, was there something in that caramel? And she just started laughing. But the caramel was good. So, I think there's probably a market for edibles and beverages. I was talking to a big-time beer company guy the other day. Just happened to be sitting next to him. We chatted it up. But, you take a look at this list. You say, okay, a lot of these companies have done very well. Ask why. Then the next question is it priced for perfection, or is it priced, really down low? And, go from there. So I'm going to be doing that. I'm going to be scouring this list to find the next couple of years winners. Why did some of the companies in the last year do really well? Why are they beaten up? Was it froth coming off, or is there really downside? Is the company really in trouble? A lot of these companies are growing, and there's good reasons to own a lot of them. So we're going to be looking at some of these. Enphase is interesting to me. I can't figure out who's going to win that market, but I'm familiar with these guys. Sarepta, I'm familiar with. I know somebody who likes Sarepta a lot. Nanostring, I don't know what that means, but it sounds interesting, right? Sometimes the names make you go, I'm going to read up on that. Silvercrest Metals, I like silver, so we'll see what that's all about. Sunrun, interesting, because we know solar is growing fast. But we're going to find some companies in these lists. And why were they growing so fast? Why the hell weren't we in them, right? And we're going to fix that. And again, we probably beat a lot of people in the market, both on the upside and on the downside. But ultimately, we didn't have the year that I wanted. So we're going to just end with, right, the good was we did a lot of things right early. And the bad was we should have taken our leverage off in September, and we should have started buying much later. This drop here, didn't expect it this year. I didn't expect it for a while. But I'll tell you this, I expect this all to replay at some point. I think that this was a warm-up for whenever the next recession is, and whenever the next time the markets thin out, and we need to keep an eye on these money flow numbers. This is good for us. This is bad for us. This is when you want to bet on things going up. This is when you want to bet on things going down, right? And this actually didn't even work so much, right? Because we started buying here, and then bam, sharp change in direction. We have to watch this. That's a peak, not a high peak, right? When this turned over before getting to the normal range, we should have caught that quicker. But again, it's a 20-day trailing measurement. It happened in 20 trading days. So we didn't have the warning. So how do we fix that? Well, maybe we change to 5-day measurements, right? Maybe we try to see how it's working shorter term. Yeah, I'm not sure why this isn't working. Right? 4 weeks is 20 days. Look at that. It's pretty low. Probably going to rebound. But is it going to hit here? Or is it going to go back up here? I think the news in the first quarter will let us know whether we break through this and go back up. Right? You know, look at a 2-week period. I don't know if that'll tell us much. Doesn't tell us much. But this smooths out the graph for us. So we can play with different things there. All right, I'm gonna let you go. Dave, thanks for coming on.
Sure, thanks for having me.
And yeah, we're still cranking out a lot of stuff. I know people have questions. I'll take a look at the chat. And I'm gonna pretty much stay home most of the weekend. Saturday night I'm going out, daughter's birthday, and New Year's Eve I'll go out just to a friend's party. But this weekend is pretty much a tie things up. We have quite a lot in the hamper. A lot of articles. Here's why oil will rise 50% in 2019. This is almost done. Just got to fill it in. How rare is a correction really? I actually stole some of this from Ave Gilbert. You know, this correction was not that rare. You should not be that afraid of it. Here's why the federal debt doesn't matter. Really, doesn't matter that much. What I subscribe to and why. So I'm actually putting this together for you all. What I subscribe to. Some of the core things. And then you can, I'm going to try to get as many discount codes for you as I can. You know, nice little article. Why I'm skeptical of Tesla bulls and bears. I think that because of Montana Skeptic, using skeptical in the title might get a couple looks. Mm-hmm. Another wave of M&A mergers coming in oil. Expect a FOMO rally into oil stocks at some point in the first half of the year. Comparing oil and gas, you know, is the Fed setting us up for stagflation? I should change that to is the Fed. You know, Fed policy versus deflation and inflation. There's a lot that we got going on here. I mean, I got 200 articles started. I have to work my way through this, probably throw 100 of them out because they're long past being useful. But there's a lot of work here that's already started. So it'll be coming out in 2019. Most of it by May. So from January to May, you should expect a pretty huge pile of information that's been scrubbed for the last several months. And this gives us some opportunity. I think that we want to scale in. And if the news ends up being not as bad as expected and is actually a positive, you're going to see a lot of money made in the stock market before the next time it does this. And it will do this again. But I think we're going to challenge these highs. And I think we're actually going to crack 300 on SPY in 2019. My prediction is 3024, just barely over 300. So 3024, that'd be S&P 500. So in any case, we're going to challenge the highs again. And then from there, I don't know, do we get this or do we get a breakout? I think the odds favor this. But you never know. Never know. Maybe the governments of the world and the central banks of the world decide that keeping prosperity is worthwhile. Maybe they decide to stray away from their silly Austrian economics and they just decide, hey, wouldn't it be nice if everybody kept getting a better standard of living? And if they do that, they start building from the bottom up, encourage entrepreneurs, not trillion-dollar companies. If they do things that make it easier for a hardworking person to get ahead rather than harder for a hardworking person to get ahead, then I think things go in the right direction. But if we keep blaming foreigners for our problems, if we keep saying, well, they're from outside our borders, therefore they're bad for us, we can't use what they bring to the table. If we keep turning away, if we keep becoming insular, we're going to have big problems. But if we embrace the world, and we, in our own localities, look to build from the bottom up, I think that we see another big rally, because there is not really any big bubbles out there. And you can listen to Jesse Colombo or anybody else you want to listen to saying bubble, 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 but they've been saying it for so long, maybe you should just think that that's where they're stuck. They've been saying bubble for 20 years, and they got one crash. We're way higher than that now. And they're going to get another crash. They'll say, look, we're right. They're not right. The stock market's been going up for a very, very, very long time. Let's see. Let's get rid of one of these. Yeah, that's not what I want. I don't want VIX. Just when you're looking for a chart. There you go. Bubble, 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 bubble. You can drag this all the way back to the 1800s. It just goes from low and left to up and right. And there's volatility. Buy, probably start to buy. You might get to here, and then you buy a whole lot. That's how it goes. The stock market goes up. It doesn't always go up, but over a longer period of time, it goes up. If you're a superstar trader, you can make some money on the movement. But if you just pick great companies and get in front of the sectors that have the tailwinds secularly, not only will you beat this, but you probably beat it by double. So there you go. That's our goal. We want to double and triple money in the next 5 years. We might have to make a couple of trades. And when I say trades, it's asset allocation changes. Right now, we're moving towards being more long, more equities in the portfolio, not less. All right, take it easy. Have a great weekend. Very happy New Year. Stay safe. And next week, we're going to go over my forecast for 2019. And we'll see how many things Dave thinks I'm wrong about.
Yep.
All right, everybody take it easy.
Have a good one. Happy New Year to everybody.